Good afternoon and welcome to the Market Wrap for APW for week ending the 23rd of July. Stuart Williamson here at the helm. So this week, what are we going to cover? Well, it's a bit of a dead period, isn't it? Sort of end of July, early August, not a lot of news out there. A lot of rehashing of what we've seen. So I thought we'd just cover some of the topics that clients brought up this week as areas of their concern. Okay, so hot topics. Mortgages, how available are they and can I get one? Okay, a lot of people putting offers in on properties, a lot of people buying properties. So can I get a mortgage? Well, pretty simply, unless you're in a very obscure dark location or a black location from an anti-money laundering perspective, then yes, you can. China was a very dark location, but now it is possible to do it. Thailand's okay. Places like Burma, no. But in general, yes. If you're in a place like Dubai, Singapore, Hong Kong, then very easy. Over £100,000 and it's going to be competitive. When I say competitive, today I was looking at stuff between 3% and 3.5%. So that's not so bad. You can get lower than that if you go for a larger deposit. So 20 to 25% loan to value will get you that sort of interest rate. Below that, 50% to 60% will get you a lower interest rate. Okay, if you're going below £100,000, during the COVID crisis, it was quite difficult to get mortgages at that level, but they are quite expensive now. We had one quote this week at 7.5%, and that was in a hardship location in a very dodgy area, to be fair. But on average, you'll be looking at less than 5%, that sort of figure for a less than £100,000 loan. So you've got to bear that in mind when comparing it against your yields and whether it's going to make a good investment or not. Should I buy in my name? Should I buy in a company name? About 75% of all purchases in the UK at the moment are going on through SPVs, single purpose vehicles. The benefit of that is if you've got a £12,500 allowance and you go back to the UK, then that's going to be probably used up by your property, and then you're going to have your own income added to the top of that. So it's going to put you into the higher rates of tax threshold. If you have 2 or 3 properties, that's for sure. So if you have an SPV, a single purpose vehicle, you can have all the properties held in that name. They don't go into your personal name and go into your personal allowances. In addition, you can still offset things like MIRAS, mortgage interest relief at source, through companies. So it's very tax efficient and the revenue wants you to do them. So which should you buy it in? It depends if you go back to the UK or not. And how many you're going to buy altogether. Where are the best locations to look to buy in the UK? Well, it's all about you've got to buy where you're comfortable and where the areas that are going up. We will give you research at APW and help you make those decisions and try and make a sound, knowledgeable opinion. Just don't buy in stupid areas because you happen to come from it. It has got to be a sound reason for post-COVID why there will be high unemployment, while lenders will see it as a good investment location and therefore lenders will lend you there. So do a lot of research. It is caveat emptor, buyer beware, very much so. Is the market still okay? Okay, is the market still okay? Well, I printed out this today from the Groydian. UK hits record number of homes sold in the month. That was 2 days ago. UK house prices rise by 10% amid stamp duty holiday rush. That was the 15th of July. UK house prices fell in June as stamp duty holiday ends, say Halifax. Home buyers rush to complete before stamp duty ends. There's loads of these headlines. It's a fury out there at the moment. People are buying, they're stamping over each other to try and get in. It's absolutely crazy. So is it a good time to buy? If you believe in the 18-year cycle, then we're only at the beginning of that, and we probably have another 3 or 4 more years to go. That may well be the case. It's never a bad time to get into the market. It's never a good time. It's time in the market, i.e. the amount of time you spend with your property, not timing the market. So it is a good time to get in. But what if you can't be bothered with all that hassle? A lot of people can't. They're coming to us and saying, well, what are the alternatives? So I put together very quickly a negative view of why you wouldn't want to buy property. It is a hassle. There's a lot of stress out there. Look at the headlines. People are trampling all over each other. Transactional costs with the new stamp duty, it's 5% stamp duty, plus probably 2% on top, so you're paying 7% to get in. Cost of renting is going up. Tax laws are changing. A lot of negatives out there, but a lot of positives as well. So it's still a good time to be buying it. What are the alternatives? cast your mind around the market. You have REITs, real estate investment trusts. They can do very well. Commercial REITs have outperformed the S&P 500 over the last 20 years by 1% per annum. So that's nearly 10% per annum they've returned with no entry costs, no exit costs. That's very good. ETFs, try those. Exchange traded funds, that could work for you. You know, Vanguard have got a very good one, and some of the people I know use Vanguard VNQ, very low cost. Property funds, you can go into the mutual fund market, you know, and buy those sort of things. Property stocks, FTSE 100 and 250 stocks. You've got Bellway, Vistry, Persimmon, and Taylor Wimpey, very much undervalued to a large extent, still going up very well. All those things can be bought very simply. Go to someone like Saxo Bank. They will help you do it very, very cheaply, 0.5% perhaps, 1% at most. You're not getting into this 6 or 7% charge. On top of that, you can do things like builder's notes, where you're lending money direct to the builder. That's a very common practice. You need to make sure it fits in with your risk profile though. And then you can do simple things like buyer's agents. Like ourselves, we're a buyer's agent, or we use search and selection people who will go out and find stuff for you, which means you don't have to get involved in a hassle. We'll do the mortgage, all that sort of thing. I mean, if you're going direct into stocks and shares, REITs and so on and so forth, the issue you have is you can't gear them. And gearing, getting a mortgage, is what makes property really work. You know, there's a BlackRock report out this week saying that they believe inflation will probably run at 3% per annum, and that the Fed has already said it will do that. If it runs at 3% per annum over the next 5 years, you know, that's 18%, 20% of a discount off your mortgage. Plus the RICS report, Royal Institute of Chartered Surveyors, for June said they expect rental incomes to go up by 3% per annum this year. So if that happened for 5 years, that's 15%. And if you have inflation going up by, you know, the same sort of thing, you're looking at a 70% drop really in where your loan is. So gearing is a great thing. If you don't want to be involved in all the hassle and the stress of jumping into the second-hand market, then buy new. You know, buying new is very easy. We're doing stuff at Cambridge at the moment. It's £13,000 down, £2,100 a month, and you've got a lovely £250,000 freehold house that we're aiming to rent to a lot of the big med tech companies down there. Alternatively, in East Midlands, £6,500 down, £1,500 a month, and we'll get you into a nice 2-bed flat up in the growth area of the East Midlands. So there's stacks of alternatives, as opposed to getting involved in the aggravation and the hassle of buying property, because it is quite expensive and it is an aggravation. But once you're in, you have the gearing that will make your money multiply for you, which is a very good thing. So we believe physical property is the way to go. The market is still running very well. Speak to us if you need any help with any of those things, and we'll point you in the right direction. Thank you very much. Cheerio.